Good morning. Today is Friday, the 13th of May. I'm Joe Terrell, president of Terrell and Company, private wealth managers in St. Louis, Missouri, with another video update on our thoughts on the economy, the markets, and where we're going to maybe end up going by the end of this year. We've been doing these videos a little more often than not because of the volatility that's in the markets, and also because the potential for what can happen with the markets. I thought today, rather than doing our normal format, I might include Dave Carter, who is head of research here at Terrell and Company, and maybe we could ask each other back and forth a few questions just to give our clients and people who follow our thoughts about the economy and markets a little bit of an update as to where we're at here in the middle of May after the action that we've seen in the markets. So with that said, Dave, maybe let me start by saying thankfully, we've been very cautious since the first of the year, particularly with fixed income staying very short, with equities making sure we stayed away from the high-tech glamour stocks that they've all hammered. Let's start with the interest rates. Do you think the markets are accurate, or am I correct that the markets seem to think that 10-year interest rates aren't going to go higher than 3.25%?
Yeah, there's some very thoughtful people who argue that rates can't go much higher than 3%, 3.25%, and they say it because there's so much government sovereign debt in the system. And that the Fed will support it in lower rates when the markets start acting very volatile and there's a sign of recession. I don't, with the inflation, I don't necessarily agree with that standpoint, because you have to have real interest rates above the rate of inflation to slow it down.
Well, I'm glad you said that, because obviously, between you and Rick, who also helps us in our investment committee meetings, we've sort of agreed that with inflation running at 8.5%, you're not going to discourage that with interest rates at 3.25%. So I think we sort of are in the camp that thinks, well, this 10-year rate 12 months from now, there's no reason it couldn't go up to 5%. It's got to get closer to the rate of inflation. If that happens, I don't think these markets are set up for that, either stocks or bonds. What do you think?
The market's not positioned for that at all. And you have to remember, interest rates are the pricing mechanism of all asset classes. And one of the biggest, I think, misconceptions are with these, you call them glamour tech, I call them hyper growth names that people have been focused, that have taken us to this point. They're long duration assets, and as interest rates go up, their current values go down dramatically. And I don't think a lot of people understand the relationship between the high growth stocks and interest rates.
Well, certainly there's quite a few people that wonder, well, what happened to Facebook and Netflix? And we can go down the list naming so many of them that are down 40, 50%. And that's certainly, we agree that, boy, there's potential more of that can happen if the interest rates go up more. So let's switch a second and talk about inflation, because if inflation is indeed going to stay at these levels, It doesn't have to move higher. And even if inflation comes down from 8.5% to only 6%, these markets are going to continue to have trouble. I think from what I see and what I read, the markets believe inflation's coming back down to 3%. Do you think the markets are structured for inflation to come way down, or what do the markets believe about inflation? Because ultimately that will ascertain where interest rates are going to be, which will entertain where prices of both stocks and bonds are going.
Well, I mean, as we sit here today, the market, as measured, is measuring long-term inflation, 10-year inflation with the sort of break-evens at like just under 3% in 10 years, and they have the market's pricing in a nice sort of glide path from the current say 4.5% down to 2.8% in 10 years, and so the market the bond market is believing the Fed will be able to taper inflation expectations, and that's supporting their thesis that inflation will be under control.
Boy, I don't see it. There are a number of noted economists that you and I share a lot of this information with each other that believe this higher rate of inflation is going to stay with us for 2 years or more. Consequently, what this means, clients, is we continue to be very negative about the potential for stocks and bonds between now and the end of the year. We believe prices can go lower on both. On the other hand, commodity prices, price of gold, price of oil, price of steel, price of copper, price of soybeans and corn, these prices have come down because people believe inflation's over with. Dave, I don't believe it. Do you?
I think there's some structural supply and demand issues going on in the commodity market that that supports higher prices. And obviously the big issue is the Russian-Ukraine conflict and all the commodities that impacts. But the oil and gas industry, the industry is not incentivized to increase production. Numbers out of OPEC yesterday, OPEC dramatically underproduced their expectations by a little over 2 million barrels. So you're at production capacity in a lot of these commodities, and as long as demand remains at current levels, it doesn't have to grow, you're going to have a good pricing environment for these commodities.
Yeah, I think there's a lot to that I get asked if the war hopefully comes to an end overseas, will the price of commodities all come back down? And I think the answer to that is no. I like to tell people in all these various commodities, production isn't like going over and putting a light switch on and off. It takes years to get production back up, and I don't see anything that leads me to believe that production of all these various things could come back. Plus, from a monetary standpoint, the Fed is not tight. The Fed's at 0.75% on interest when inflation's running at 8.5%. Dave, that's not tight. That's less easy than they were before, but it's certainly not tight.
Well, and keep in mind with this deglobalization, I'm going to say, where Intel is spending $100 billion in new chip capacity, and the reshuffling of supply chain, that's going to that's going to require a lot of capital investment, which is going to require a lot of commodities, steel, copper, cement.
But it's going to take time
It's
also.
going to take time, and it's also going to take money, which is going to be sucked out of the system that normally that historically in recent years has gone to the Treasury market, and that money is not going to be there. Intel is not going to have $15 billion of free cash flow that they're going to invest in treasuries and cash. They're going to have $15 billion they're going to invest in plant. And so there's going to be less demand for interest for treasuries and bonds, in my mind.
Brian, and I refer to, for our viewers, Brian Curtis, our producer. We'd better stop there. We could go on talking for a half hour or more about some of these issues, but we just want to update our followers on the fact that we remain bearish on the economy, on investment markets, and we think it is a very proper place to stay in that cautious attitude until we can see how this is going to work out. How high will the Fed raise interest rates in an effort to bring inflation under control? And what will markets do about repricing investments to reflect the higher interest rates? So Brian, we thank you, and we'll be back as events warrant. In any case, we'll probably be back in 2 to 3 weeks with another video update. So thanks for tuning in, and we'll see you in 2 or 3 weeks.